Partner fights in real estate investing don't just kill deals, they kill friendships, drain bank accounts, and turn what looked like a passive income dream into a full-time legal nightmare. We're talking about partnerships that started with handshakes and ended with courtroom subpoenas, and the wild part is almost all of it was completely preventable. The catalyst here isn't greed or bad luck, it's ambiguity. And ambiguity is basically jet fuel for resentment between people who were once aligned. When 2 or 3 people throw money into a deal together without spelling out the rules, every future disagreement gets filled in by assumption, and assumptions are where partnerships go to die. Think of an operating agreement like the prenup nobody wants to talk about at the wedding. The conversation feels awkward right up until the moment you desperately wish you'd had it. The macroeconomic reality is that real estate cycles create pressure, and pressure has a way of exposing every crack in a relationship that a bull market was papering over. There was a moment not long ago when everyone was raising capital from friends and family like it was a sport, syndicating small multifamily deals over dinner and assuming good vibes would carry the day. Those good vibes have a shelf life, and that shelf life expires the first time a roof needs replacing, and nobody agrees on who decides the contractor. The optimism of easy money masked the very human truth that people have wildly different definitions of what equal partnership actually means. Psychologically, the damage starts before any real conflict erupts. It starts the moment one partner feels like their voice doesn't count, and that feeling festers quietly until it explodes publicly. Even sophisticated investors with great instincts have admitted they underestimated how emotionally loaded money decisions become when they're entangled with personal relationships. History is littered with cautionary tales, from 1999.com co-founders to 2008 real estate joint ventures, where the deal itself survived, but the partnership didn't. And the legal unraveling cost more than the original investment. Every cycle feels different in the moment, but the pattern of underdocumented partnerships blowing up under stress is one of the most reliable constants in all of investing history. Real estate partnerships fail for predictable, cyclical reasons that the community has documented over and over, and the wisdom is freely available. If you're willing to look, seasoned operators will tell you almost universally that the operating agreement is the single most important document in any joint venture. The irony is that most new investors spend more time analyzing cap rates than they do defining what happens when a partner wants out. Here's the misconception worth destroying right now. An operating agreement isn't a sign of distrust. It's the opposite. It's a sign that you respect your partner enough to protect both of you from your future selves. The fear that bringing up legal documents will make things weird is exactly backwards, because nothing makes things weirder than a $400,000 dispute with no written framework to resolve it. Practically speaking, every solid operating agreement needs to address at minimum 5 things: decision-making authority, capital call obligations, buyout mechanisms, profit distribution, timing, and dispute resolution procedures. Historical lesson learned the hard way by thousands of investors before you. The buyout clause is the one people skip, and the one that burns them most. So define the valuation method, the notice period, and the right of first refusal before you ever wire a single dollar. Disciplined partnership structuring means you're not betting on the relationship staying perfect. You're building a system that works even when it gets imperfect, because it will get imperfect. Unemotional strategy here looks like sitting down before the deal closes and role-playing the uncomfortable scenarios. What if one partner loses their job? What if someone wants to sell in year 2 and the other wants to hold 10 years? What if a major repair tanks cash flow for 6 months? Process matters more than conviction when structures are concerned. And position size, meaning how much of your personal net worth and emotional bandwidth you're concentrating in any one partnership, should discipline how much complexity you're willing to absorb. The partners who survive long-term aren't the ones with the best instincts. They're the ones with the clearest agreements and the lowest tolerance for operating in gray areas. At its core, the operating agreement is a philosophical statement about how you view collaboration. It says, we believe in this deal and we believe in each other enough to protect both from ambiguity, discipline, proper sizing of your exposure, and consistency in how you document every venture will compound your reputation and your returns far more than any single hot deal ever could. And honestly, if you structure it right, and the partnership still faces headwinds, you'll be glad you built the parachute before you needed it. Rational preparation isn't pessimism. It's the most optimistic thing you can do for a long-term investing career. The investors who sleep well aren't the ones with perfect partners. They're the ones with airtight agreements. Whether you're structuring your first joint venture or renegotiating an existing partnership, check out our links in the description below. We can help you get started with real estate investing, connect you with trusted home contracting professionals, and point you toward the right lenders for your next deal.